Want to keep more of your hard-earned money in retirement? I'm about to share 4 strategies that could potentially save you thousands in taxes. If you're approaching retirement or already are there, you know how crucial it is to make your money last. But here's something many people overlook: the impact of taxes on your retirement savings. I'm Bowman, and after helping hundreds of retirees navigate this complex landscape, I can tell you that smart tax planning could make a big difference between a stressful retirement and a dream retirement. Today, I'm going to share 4 time-tested strategies that could potentially save you thousands in taxes and help you enjoy the retirement you've worked so hard for. These aren't just theoretical concepts. These are battle-tested strategies I've used with my own clients to help them reduce their tax burden and maximize their retirement income. So if you're ready to keep more of your hard-earned money and live your ideal retirement, stick around. Strategy number 1, diversify your retirement accounts by tax treatment. The first strategy is all about preparation, and ideally, you want to start this before you retire. It's called diversifying your retirement accounts by tax treatment. Now, what do I mean by that? Most people are familiar with traditional IRAs and 401ks. These accounts give you a tax deduction when you contribute, but you pay taxes on every dollar you withdraw in retirement. That's great, but it's only part of the picture. You might want to also have some Roth accounts. With Roth IRAs or Roth 401ks, you pay taxes on the money going in, but then it can grow tax-free, and you can make qualified withdrawals tax-free in retirement. This gives you much more flexibility to manage taxes in the future. Lastly, don't forget about taxable brokerage accounts. These don't have special tax treatment, but they do offer some possible tax advantages. You can access this money anytime without penalties, and you'll pay lower capital gains rates on growth instead of higher ordinary income tax rates by having all 3 types of accounts: tax-deferred, like traditional IRAs, tax-free, like Roths, and taxable. You're setting yourself up for greater flexibility and control over your tax situation in retirement. You can strategically withdraw from different accounts each year to help manage your tax bracket and potentially pay thousands less in taxes over your retirement. Strategy number 2, Roth conversions in lower income years. Now, let's talk about Roth conversions. Many people think Roth conversions are only for pre-retirees, but that is a myth that could be costing you money. Here are the facts. The early years of retirement can be a really good time for Roth conversions. Why? Because your income might be lower, and therefore you may be in a lower tax bracket, especially if you've just stopped working but haven't started taking Social Security yet. When you do a Roth conversion, you're essentially moving money from a traditional IRA to a Roth IRA. You pay taxes on the amount that you convert, but then that money can grow tax-free and can be withdrawn tax-free in the future if you follow the IRS rules regarding Roth distributions. The key is to convert just enough to fill up your current tax bracket without pushing too far into the next one. For example, if you're in the 12% marginal tax bracket, you might convert just enough to get you to the top of that bracket, but not so much that you hit the 22% bracket. This strategy can be particularly powerful if you expect to be in a higher tax bracket later in retirement, perhaps due to required minimum distributions or delayed Social Security benefits. By paying taxes now at potentially lower rates, you're essentially locking in that rate and protecting yourself against future tax increases on these funds. Remember, tax brackets are historically low right now, and with the national debt growing, many experts believe tax rates will increase in the future. Roth conversions help you to take advantage of today's low rates. Strategy 3, capital gain harvesting. Our third strategy is called capital gain harvesting, and it can be a powerful tool for helping you manage taxes in your non-retirement accounts. Here's how it works. In years when your income is lower, you might be in the 0% long-term capital gains tax bracket. Yeah, you heard that right, 0%. For 2025, that applies to married couples with taxable income up to $96,700 and singles up to $48,350. If you're within this bracket, You can sell appreciated investments that you've held for more than a year and pay no federal tax on the gains. Then, assuming you follow the wash sale rule, very important, you can repurchase those investments if you want to keep holding them. This resets your cost basis higher, reducing your potential tax bill when you eventually sell those holdings in the future. Even if you're not in the 0% bracket, harvesting gains in the lower income years when you're in the 15% capital gains bracket instead of potentially the 20% bracket can still save you money. This strategy requires careful planning and coordination with your other income sources, but it can result in significant tax savings over time. Strategy 4, qualified charitable distributions, or QCDs. The fourth strategy I want to share is using qualified charitable distributions, or QCDs, to help satisfy your required minimum distributions from traditional IRAs. Once you turn the age in which RMDs start, and that age is determined by your year of birth, the IRS requires you to start taking distributions from your traditional IRAs and 401ks, whether you need the money or not. These RMDs are taxed as ordinary income and can push you into a higher tax bracket. Now, if you're charitably inclined, QCDs offer a potential workaround. Here's how it works. Instead of taking your RMD and then making a charitable donation, you can direct your IRA custodian to send up to $108,000 per year directly to qualified charities. This amount counts towards your RMD, but it's not included in your taxable income. This strategy works even if you take the standard deduction and don't itemize. That's a very special component of the QCD. It's like getting a charitable deduction on top of your standard deduction. Plus, by reducing your modified adjusted gross income, QCDs can help you avoid or reduce other taxes and surcharges, like the Medicare premium surcharge or the tax on some Social Security benefits. There you have it, 4 powerful strategies that can help reduce your taxes in retirement. From diversifying your accounts and making strategic Roth conversions to harvesting capital gains and using qualified charitable distributions, these techniques can help you keep more of your hard-earned money and enjoy the retirement that you deserve. Remember, tax planning in retirement is not a one-time event. It's an ongoing process that requires regular review and adjustment. That's why working with a qualified financial advisor who specializes in retirement planning can be so valuable. If you found this information helpful, please be sure to like the video and subscribe to my channel for more retirement planning insights. And if you're ready to take the next step in optimizing your retirement strategy, I invite you to book a call with me and my team. The link is in the description below. Until next time, this is Eric Bowman wishing you a prosperous and tax-efficient retirement. Thanks so much for watching.